When looking at online financial institutions like Brilliant Bank, a common misconception is that banks can randomly wake up one morning, snap their fingers, and raise or lower the interest rates on all accounts completely at will, just because they feel like it. The reality of how financial institutions operate involves a careful balance of market competition, federal monetary policy, and the specific legal structures of the banking products they offer. To understand how interest rates are actually adjusted, it helps to look at the broader economic ecosystem. Financial institutions do not operate in a vacuum. The central bank of a country, such as the Federal Reserve in the United States, sets the benchmark federal funds rate. This benchmark rate dictates how commercial banks borrow and lend money to each other overnight. When the central bank shifts its monetary policy to combat inflation or stimulate economic growth, it directly impacts the cost of money across the entire financial sector. Because Brilliant Bank offers variable rate products like online money market accounts, the yields on those specific accounts can fluctuate over time. However, these changes are rarely arbitrary. If Brilliant Bank decides to lower the annual percentage yield on a flexible savings or money market product, they risk triggering an immediate mass exodus of depositors. In the modern digital banking landscape, customers can easily move their capital to competing online institutions offering higher returns with just a few clicks. Therefore, lowering rates at whim would destroy their deposit base, which they rely on to maintain liquidity and fund their business model. Conversely, raising interest rates is also bound by strict economic realities. While a higher APY attracts new customers looking to maximize their savings, paying out higher interest costs money. Banks must generate enough revenue through lending, mortgages, and other investments to cover the interest they pay out to account holders. If a bank raises its rates too high without a corresponding return on its assets, it will severely compress its profit margins. Every interest rate adjustment is a calculated strategic move designed to maintain profitability while remaining competitive in a crowded marketplace. The distinction between variable and fixed products also dictates how interest rates can be modified. For accounts like certificates of deposit, the rules are rigidly bound by contract. When a customer locks funds into a fixed-term certificate of deposit, the financial institution legally cannot change that rate midway through the term. Whether market interest rates skyrocket or plummet the day after the account is opened, the agreed-upon yield remains locked in until the maturity date is reached. This protects both the consumer and the institution, ensuring predictability on both sides of the transaction. Market forces further constrain any arbitrary decision-making. The banking sector is intensely competitive. Institutions constantly monitor what rival banks are offering for savings accounts, money markets, and loans. If Brilliant Bank were to disconnect its rates from macroeconomic realities and market trends, they would quickly lose market share. Competitors would either undercut them to steal their borrowers or outpace them to capture their savers. Regulatory compliance and internal liquidity management also play massive roles. Banks are heavily regulated to ensure they maintain sufficient capital reserves to protect consumer deposits. Adjusting interest rates is a primary tool used by asset and liability management committees to control the flow of cash coming in and going out of the institution. If a bank is holding more cash than it currently needs to fund loans, it might lower its savings rates to slow down deposit growth. If it needs more capital to meet lending demands, it will raise rates to attract fresh funds. Ultimately, interest rate adjustments are driven by a complex web of macroeconomic indicators, competitor positioning, liquidity requirements, and legal contract terms rather than casual corporate decisions. Financial institutions must constantly adapt to the financial climate dictated by central banks and consumer demands.